Plan, 403B, 457B, 409 Cap A, and IRA documents, and was the author of other publications. Stephen was a tax law specialist at the National Office of the Internal Revenue Service, Employee Plans Division. After receiving his bachelor's degree, he graduated from Willamette College of Law. He then went on to attain his Master's of Law degree in taxation from George Washington Law Center. Tim McCutcheon is the publisher of Aristopedia.com and the president of Vermont Compliance Labs. Tim is also the founder of ftwilliam.com, the most innovative document and government forms provider in the industry. He wrote the first web-based 5500 forms package and introduced the first retirement plan document e-sign system. Tim is a member of the IRS Great Lakes TEGE Council and a former member of the Information Reporting Program Advisory Committee of the IRS. Prior to founding Aristopedia.com and ftwilliam.com, Tim's law practice included counseling TPAs, financial service companies, and other benefit service providers regarding qualified plan, product design, and compliance issues. Tim received his JD cum laude from the University of Wisconsin-Madison. He also holds a CPA and an MBA degree from the Kellogg School of Management at Northwestern University. Slide, so you see, I'm your facilitator, Chuck Gouge, and we do have a question board that's going to be monitored by Maureen Pesic. On the next slide, you'll note that all your lines are muted, but we do have the question board available. So please look over to the right, the Q&A section. You can ask a question. We're trying to monitor that as the presentation goes on. Stephen will try to answer some during the presentation, but also post answers to the questions we don't get to on aristopedia.com/webcasts on our website. The slides will be available, and a recording of this webcast will be available there on our webpage. So take it away, Stephen. I think you've got the ball. Oh, I guess we could talk about CE credit, but go ahead. I'll cover that at the end, too. I'll cover that at the end as well.
Okay. Well, it's a pleasure to be with everyone today. As many of you know, when I was at the IRS National Office, I spent a lot of time dealing with plan corrections. I was part of a task force that was working on the first correction procedure. I also spent a lot of time dealing with plan disqualification. For a while, when I was at the IRS, my title was the Prince of Darkness. Well, today what I'm going to do is help you figure out how to correct elective deferral failures. As Chuck mentioned, for several years my wife and I were off on a church mission, and when I came back, I immediately jumped into the new EPGARS procedure. And one of the things that kind of surprised me was some of the new methodology that they had provided in correcting elective deferrals. Unfortunately, it's kind of confusing. It took me a while to decipher that. They just kind of overlaid it on the existing rules with respect to correcting elective deferrals. Unlike many areas dealing with plan corrections, when we're dealing with 401k plan elective deferral failures, and by the way, this would be the similar corrections for 403Bs and even 457s if you have these failures. But unlike most plan corrections where you're just given guiding principles, with respect to 401k plan elective deferrals, they have very specific rules for most of the errors. And the reason the service has done this is because, first of all, there's a lot of these errors, and secondly, because it's so important. 401k is the primary retirement plan in the country right now, and they want to make certain that participants are getting their contributions into the plan, as well as other contributions like matching contributions that are tied to it. So we're going to walk through the various rules with respect to correcting elective deferrals. Now, the two failures we're going to focus on the most, which are the two most common. They are the lion's share of 401k elective deferral failures, and that's the failure to implement a deferral election. In other words, a participant makes a deferral election online or with paper or however the plan provides for it, and the plan just doesn't implement its deferral election. It falls through the cracks. Somehow they just don't implement it. There's some, and with, because there's so many participants in 401k, and you got payroll systems, and you got communications between the employer and the payroll and the trustee, there's just a lot of opportunity for this type of failure. The other type of failure is improper exclusion. That's where a participant has met the eligibility requirements and should enter the plan on a particular date, but for some reason he or she is prevented from entering. Oftentimes you see this where the employer misapplies the eligibility conditions. Many 401k plans now have early eligibility provisions. In other words, you don't have to wait the traditional 1-year service to enter into the plan. But the rules regarding early eligibility are in of themselves kind of complicated. And employers misapply those, misinterpret those, and therefore an individual is kept out of the plan longer than he or she should have been kept out of the plan. So those are the two most common. And you'll see some slight variations in how we correct with respect to these types of failures. Now, as I've already mentioned, with respect to correcting elected deferrals, the IRS has very specific methods for correction, and they have added to these over the years and modified these over the years. They realize that this is, like I said, an important correction that needs to be made and a common error, and so they have provided very specific rules. Most of these errors are operational errors, and for the most part should be able to be corrected under the self-correction program. Now, as I mentioned, they've added some rules with respect to them, and what can be a little bit confusing is they call these safe harbors. We're not talking about safe harbor 401k plans. We're talking about safe harbor correction rules. Now, which rule you use will depend on how quickly you catch the error. So there is an encouragement to try to catch the error early and obviously implement the corrections. So we will, having a little trouble with, there we go. Slide's not moving as fast as, okay, having just a little bit of, there we go. Okay, let's start with the general rule, but let me caution you right off with respect to the general rule. You almost never apply it, but you need to understand it because that provides the basis for purposes of understanding the safe harbor rules. You're more likely to use the safe harbor rules. Now, the rule with respect to correcting an improper exclusion, so that's where I've been, told that I'm not eligible or not eligible yet, is that the employer makes a QNEC contribution equal to the missed deferral opportunity. The missed deferral opportunity is a term of art. The missed deferral opportunity is 50% of the missed deferral. That's another term of art, missed deferral. I'll explain what those are in just a moment. So in a traditional 401k, the missed deferral is the average ADP of the group to which you belong. So if you're highly, it's the average ADP for that year, or if you're non-highly, it's the average ADP for that year. Now, in a safe harbor 401k plan, the missed deferral is the greater of 3% or the maximum deferral percentage for which the employer provides a matching contribution rate at 100%. So you can see that how you calculate it differs depending on whether you have a traditional or a safe harbor 401k plan. So that now the plan will calculate the missed deferral for the portion of the plan year for which the employee was improperly excluded. That's the missed deferral. And then the general rule is the QNEC contribution is 50% of that missed deferral. Now, again, we have not got to the safe harbors yet. Okay, I'm still having trouble moving, so I'm just going to. Okay, now most plans also have a matching contribution tied to the elective deferrals. And so you first calculate the missed deferral. In correcting the match with respect to that, the employer applies the plan's matching formula to the missed deferral, not the missed deferral opportunity, which under the general rule is 50%. You apply it to the full missed deferral. Now, the matching contribution, of course, is subject to any statutory limits like 415 and any plan limitations with respect to it. For a safe harbor match, the employer would make that match in the form of a QMAC, qualified matching contribution. For a regular match, the corrective contribution would be subject to the plan's vesting schedule. You'd still make the matching contribution, but it would be subject to whatever the vesting schedule under the plan is. Now, depending on when the correction is made, the QMAC as well as the match is also going to be subject to earnings. In other words, you look at the deadline for which it should have been contributed, and then you calculate the earnings from that particular point. Additional rules for elected deferral corrections. Now, the plan will also need to include earnings. The IRS is obsessed with earnings. Other rules: improper exclusion plan uses the average ADP for the year of the exclusion, regardless of whether the plan uses prior year testing. Corrective contributions are always subject to the plan and statutory limitations. It's like 402G and 415. In calculating the missed deferral, the plan may not use the otherwise excludable employee rule, where you're allowed to divide the plan into two. You just have to figure out what the average ADP of the group to which the employee belongs. Now, correction methods do not apply until the correction of other qualification failures have been completed. In other words, the plan disregards the improperly excluded employees or employees for whom the plan failed to implement the deferral elections in applying the ADP and ACP test. So you do not include them in the test, and then you correct. Now, these additional rules also apply for a failure to implement a deferral election. Now let's go to an example. I always understand things better when I have an example. So Company X maintains a 401k plan. The plan administrator misapplied the eligibility requirement and delayed Dan's entry into the plan until July 1st, 2017. Dan should have entered the plan on January 1st of 2017. His compensation for the entire plan year is $50,000. The average ADP for the non-highlights is 3.5%. So the missed deferral is 3.5% of the compensation for the period of time in which he was improperly excluded. The plan's matching formula is 100% of elective deferrals up to 3%. So the plan corrects this elective deferral failure by making a QNEC to Dan's account of $500 plus earnings. So the calculation is as follows. You've got, actually, it's not $500. That's a typo there. So what you do is you figure out he was improperly excluded for 6 months of the year. So his compensation is 25%. The missed deferral is 3.5%. So 3.5% of $25,000 is $875. You take 50% of that, and it's $437.50. So that's a mistake up there where it says 500. It's $437.50. Now, the employer would also need to correct for purposes of the match, and the match would be 100% of deferrals up to 3%, because it's according to the matching formula. So they would also make a corrective contribution of $750 for purposes of correcting the match. Now, these will also have to include earnings. We'll talk about earnings in just a little bit. Now, let's go to a safe harbor 401k example. Same situation. The employee was improperly excluded. It's a safe harbor 401k plan with a matching formula of 100% of elective deferrals up to 4% of compensation. The plan administrator misapplied the eligibility requirements and delayed Ann's entry into the plan until July 1st. She should have been in the plan January 1st, so she was improperly excluded for 6 months. The compensation's $50,000. The plan corrects the elective deferral by making a QNEC to Ann's account of $500 plus earnings. Let's figure out how we calculate it. The missed deferral is 4%, so it's 4% of 6 months of compensation, 25,000. So that's 1,000. 50% of that is $500. So we would contribute a QNEC equal to $500 plus earnings with respect to that. For purposes of the match, the employer would make a corrective contribution using the plan's matching formula against the full missed deferral. So that would be $1,000, and that would be in the form of a QMAC, a qualified matching contribution, which is, of course, 100% vested. So the methodology is the same, but the way, the mechanics of how you calculate the missed deferral differ depending between a traditional 401k and the safe harbor 401k. Now, let's talk about the failure to implement a deferral election. So an employee makes a deferral election, but through some sort of error, it just falls through the cracks. You know, as the slide indicates, one of the administrative challenges in maintaining a 401k plan is the timely and properly implementing participants' deferral elections or a change in the deferral election. So if an employer fails to implement a participant's deferral election, the participant gets the benefit of receiving his or her own compensation instead of having the compensation deferred. Now, the employer, to correct this, will make a corrective contribution to the participant's account to correct the failure. Now, the methodology is similar but not identical to the correction for an improper exclusion of an eligible employee. Unlike the improper exclusion correction, in the case of a failure to implement, we actually know what the participant was going to defer because they made an election. So the missed deferral is based on their actual election. Now, again, we're still under the general rule. We haven't got to the safe harbors yet. With respect to a failure to implement a deferral election, the correction method is the same as it is for a traditional 401k plan. The plan corrects by making a QNEC contribution equal to the missed deferral opportunity. The missed deferral opportunity is 50% of the missed deferral. Remember, the missed deferral is actually their election applied against their compensation. And we have the same calculation for both the traditional and the safe harbor because we know what the election is. And of course, we need to include earnings with respect to that. So let's go through an example. Company X maintains a calendar year 401k plan. Then made a 5% deferral election effective January 1st, 2017. His monthly compensation is $5,000. The plan administrator failed to implement the election, and the error was not caught until May 1st, 2017. The plan would correct the failure by making a QNEC to Ben's account amount of $500 plus earnings, and the calculation is as follows. So his deferral election is 5%, and his comp for the 4 months that he was improperly or they failed to implement his deferral election is $20,000. So 5% of $20,000 is $1,000. That's the missed deferral. And then the missed deferral opportunity is 50% of that, or $500. The exact same result would apply with respect to the Safe Harbor 401k as far as correcting the elective deferrals. Now, many participants are doing Roth, so the question comes up, well, what about a Roth deferral if they make an error, failure to implement, or improper exclusion? You still, you still correct by making a QNEC contribution to the participant's account. They don't get the benefit of the Roth. It's just going to be a QNEC. Now, we talked about how we correct the elective deferrals. What about the match with respect to a situation where we have a failure to implement the deferral election? As with the correction for the improper exclusion, the plan is going to apply whatever the plan's matching formula against the missed deferral, not the missed deferral opportunity. So the plan first calculates the missed deferral, then applies the plan's matching formula to the missed deferral to determine the proper matching formula. Again, the match is subject to the statutory and plan limits, so they would not exceed those. If the match is a safe harbor match, then it would be in the form of a QMAC. Otherwise, it's going to be subject to the plan's vesting schedule. And of course, again here, you calculate earnings with respect to the match. Okay, let's go to an example. Okay, this is, again, we're focusing on failure to implement a participant's deferral action. So assume the same facts in the previous example, except the plan also includes a matching formula of 100% of deferrals not exceeding 4% of compensation. So remember the facts, the individual made a 5% deferral election. They improperly excluded him. They didn't catch the error to May 1st. He's got $20,000 of compensation during that 4-month period. To correct, the plan applies the plan's matching formula to the missed deferral. So it's 100% of elected deferrals up to 4. That's the matching formula. So the correction with respect to the match would be $800. And it would potentially need to be adjusted for earnings. But remember, a match, you have a different deadline for making a matching contribution, so your basis for calculating the earnings will be different too. If the plan were a safe harbor 401k and the match were a safe harbor match, it would be in the form of a QMAC contribution. Okay, let's go to another example. Assume the same facts as in the previous 2 examples, except the plan also includes a matching formula of 100% of elected deferrals not exceeding 6% of compensation. So they have 2 matching formulas. In particular, a lot of safe harbor 401k plans stack the matching formulas, as we call it, so they have additional ones. Again, the facts are we failed to implement the 5% deferral election for 4 months. Compensation is $5,000 a month. The match, this additional match is subject to a vesting schedule, as it typically is even in a safe harbor 401k plan. The missed deferral is $1,000. So the plan also would receive an additional contribution for this match of $1,000. We take 100%, in this case up to 5%, which is $1,000, and this corrective contribution would be subject to the plan's vesting schedule and then potentially earnings depending on when it's contributed. Okay, so we've talked about the general rule applicable to both a failure to implement as well as an improper exclusion. The key there, of course, is calculating the missed deferral. Let's talk about the brief exclusion rule. This has been around for a while, and there's a safe harbor rule with respect to the brief exclusion rule now too. Now, the non-safe harbor correction method for a brief exclusion. Under the non-safe harbor rule, and that's what we kind of have to call it to distinguish it from the safe harbor, an employer may correct an improper exclusion. Let me emphasize this. In the non-safe harbor, the rule that's been with us for many years, it only applies with respect to an improper exclusion. So you're eligible, but the employer told you you weren't eligible, so you're improperly excluded for a period of time. If they catch it quickly enough, then the employer does not have to make a QNET contribution to correct for the missed deferrals. Now, in order to avoid the requirement to make a corrective contribution for the improper exclusion, the employee has to have the opportunity to make elective deferrals under the plan for at least 9 months. So you have to catch it within the first 3 months of the plan year, and you still have to have at least 9 months left in the plan year, and you have to be able to defer what you could have done for the full 12 months. That's requirement number 2. And the third, if the participant would have been entitled to a matching contribution on the missed deferrals, the employer does have to make a corrective contribution with respect to the match. So you do get a pass on making a QNET contribution to correct for the missed deferrals. But as you can see, this is, the improper exclusion has to occur within the first 3 months of the year, and the employee still has to be able to have 9 months in order to use this. Furthermore, this is only available for improper exclusion, not a failure to implement. Example, Company X maintains a 401k plan. Don is eligible on January 1st, 2017, but he's informed that he's not eligible. They catch the error on March 1st, 2017, allow Don to commence making elective deferrals. The non-safe harbor rule is available because he still has 10 months left in the year in which to defer, and as long as he's allowed to defer as much as he could have if he had deferred for the entire 12 months, he would be fine. Now, if the plan has a matching formula, they would need to make a corrective contribution for the match for the 2 months of missed deferrals, again, subject to the plan limitation. Company X, oh, wait a second. Oops. Example, Company X maintains 401k, Don is eligible and makes a deferral election of 4%. They failed to implement the election until March 1st, 2017. In this case, you have to correct that. The non-safe harbor brief exclusion rule is not available to correct because it only applies to improper exclusion. However, I keep teasing you with this. You will be able to correct under the safe harbor brief exclusion rule, but we're going to get to that in just a moment. Example, Company X maintains a safe harbor 401k with a periodic safe harbor match of 100% of deferrals up to 4% of comp. Don, again, is earning $5,000 a month, is improperly excluded for the first 2 months of the year. The missed deferral is 4%. And of his $10,000 of comp, his 2 months of compensation. X corrected the failure on March 1st, 2017. So X does not need to make a corrective QNET contribution for the missed deferral because of the brief exclusion rule. Don can increase his deferrals during the last 10 months to make up for the improper exclusion. However, X must make a corrective QMAC. This is a safe harbor plan of $400, 100% of deferrals up to 4%. Same result in a traditional 401k, but the match would be subject to vesting schedule. Let me note here, though, if Don increases his deferrals for the latter part of the year, then you may actually reach your matching limit, and you may not need to make a matching contribution. It depends on whether your match is an annual match or a periodic match, because it's subject to the plan's limitations, whatever they are. But if they're not reaching their limits, then the plan needs to make a corrective contribution for the matching contribution. Now, let's talk about the safe harbor brief exclusion rule. This is a new rule added with the EPCRS procedure, with the modification of the EPCRS procedure. Under this safe harbor, an employer can correct elective deferral failure. That's both a failure to implement as well as an improper exclusion, so it's available for both. And they can do it just like the non-safe harbor without making a QNEC for the missed deferrals if they meet the following three conditions. They correct deferrals no later than 1, the first payroll date on or after the last day of the 3-month period that begins when the failure first occurred. So again, this 3-month period. Or if the employer was notified by the affected participant the first payroll date on or after the end of the month following the notification. Now, for a failure to implement a deferral election, the employer simply implements the deferral election the participant made. For an improperly excluded employee, they would need to communicate the deferral option to the employee and then implement whatever his or her election would be. Now, as part of the safe harbor, the employer has to provide a notice of the failure to the affected participants not later than 45 days after the date in which the employer implements the participant's deferral election. So this is a negative, if you will. There's an additional requirement that you have to provide this notice to the participants. And thirdly, if the participant would have been entitled to a matching contribution on the missed deferrals, the employer makes a corrective contribution equal to the matching contribution, subject to plan and statutory limits. Now, it's important to note here that not only does the safe harbor brief exclusion rule apply to both failure to implement and improper exclusion, it has a rolling 3-month period. What I mean by that is that it doesn't have to be the first 3 months of the plan year. Someone could enter in the middle of the year, and if you caught it within the first 3 months after that time period, you can take advantage of that particular rule. So it doesn't have that narrow limitation of just at the beginning of the plan year. So let's go through an example. Company X maintains a 401k plan with a periodic match of 100% of deferrals up to 4% of compensation. Emma makes a 4% deferral election. Compensation is $5,000 a month. So she made this 4% deferral election on July 1st, 2017, but X failed to implement it until they caught the error on September 1st. Now, under the non-safe harbor rule, they wouldn't be able to use this because you still have to have 9 months. You still have to have 9 months left in the plan year after the correction. But with the safe harbor rule, it's a rolling. X need not make a corrective QNEC contribution for the missed deferrals because of the brief exclusion rule, the safe harbor brief exclusion rule. However, X must make a corrective contribution of $400 plus earnings to correct the match. You take the plan's matching formula and you apply it against the missed deferral. If it's a safe harbor 401k, it's a QMAC. Otherwise, it's subject to the plan's vesting schedule. Assume the same facts in the previous question, except X improperly informed Emma that she was not eligible until July 1st. X discovered the error and allowed her to make elective deferrals on September 1st. The brief exclusion rule applies there. Remember, it applies to both improper exclusion as well as failure to implement. However, X must make a corrective, so they don't have to make a QNEC contribution because of the safe harbor rule. However, they do have to make a corrective contribution for the match. Okay, now this is another safe harbor rule. So these safe harbor rules will largely supplant the general rule. So you generally use the safe harbor rule unless it doesn't apply. And if it doesn't apply, then you go back to the general rule. Okay, now this safe harbor rule, let me just emphasize something here. This is for elective deferral failures, both types, that are being corrected beyond the 3-month period that the brief exclusion rule applies, but no later than 2 years. So no longer than 2 years following the failure. So under this safe harbor, an employer may correct the elective deferral failure by making a corrective contribution of 25%. This is instead of 50%, so it's going to save you money rather than the normal 50% that's under the general rule. The employer provides, now you got to meet the following three conditions. The employer provides the employee the opportunity to make elective deferrals in the plan not later than the earlier of the last day of the second plan year following the plan year in which the failure occurred, or if the employer was notified of the failure by the employee the first payroll date on or after the end of the month following notification. So it's a window of time. It's beyond 3 months and the end of the second plan year after the plan year of the failure. You have this window of opportunity to use the safe harbor correction method. Now, as part of this, you also have to provide the affected participants a notice no later than 45 days after the date on which the employer implements the participant's deferral action. And thirdly, if there is a matching contribution, then you have to make a matching contribution on the full missed deferral using the plan's matching formula. You calculate the missed deferral the exact same way. It's just the correction under the safe harbor rule is 25% rather than 50%. Oops. Let's go through an example here. Company X maintains a safe harbor 401k plan with a periodic safe harbor match of 100% of deferrals up to 4%. Ben makes a 5% deferral election. His comp's $5,000 a month on his entry date of July 1st. He made this election, but X failed to implement it until January 1st, 2018. So there's a 6-month error there. To correct, X needs to make a corrective contribution for the missed deferral, which is his 5% deferral election against 6 months of compensation. So that's 5% against $30,000. So his missed deferral is $1,500. The corrective contribution is 25% plus. Is 25% of $1,500 plus earnings. X also, so that's $375. X also must make a corrective QMAC contribution of $1,200. You take the plan's matching formula, which is 100% up to 4, and so they make a $1,200 contribution. Since this is a safe harbor 401k, that matching contribution would be in the form of a QMAC. The result would have been the same in a traditional 401k, but the corrective contribution for the match would have been subject to the plan's vesting schedule. Okay, let's go through another example. Assume the same facts in the previous question, but X improperly informed Ben that he was eligible on January 1st on January 1st, 2018, rather than his correct eligibility date of July 1st, 2017. X discovered the error and corrected it as follows. X calculates the missed deferrals. Remember, this is a safe harbor plan, so since we don't have a deferral election, because he was improperly excluded, he it's the greater of 3% or the highest level which the plan matches at 100%. So that's 4%. 4% of his $30,000 of compensation during that 6-month period would be at $1,200, but the QNET contribution is 25% of that, or $300 plus earnings, and then the plan would apply the matching formula against the full missed deferrals. Let's go to a traditional 401k plan example. Assume the same facts in the previous question, except the plan is a traditional 401k plan. Again, it's improper exclusion. They improperly informed that he was not eligible until July 1st or January 1st, but he was actually eligible previous July 1st. The average ADP for the group to which the participant belongs is 3.5%. So you calculate it, you take the 3.5%, apply it against $30,000. So his missed deferral is $1,050. 25% of that is $262.50 plus earnings. And then you take the plan's matching formula, which is it's 100% up to 4, so it's 100% of the missed deferral, in this case $1,050, and you would make a contribution for the matching contribution. Now, under the safe harbor rule, remember there's a notice requirement. Under the safe harbor brief exclusion rule, under the safe harbor rule for elective deferral failures caught between 3 months and 2 years after the failure occurs, the notice content is set out here in the slide. You have to provide certain general information regarding the failure. You'll see what that is, a statement that the appropriate amounts have begun to be deducted from the compensation contributed to the plan, a statement that corrective allocations have been made or will be made, information relating to the date, explanation may increase his or her deferral elections to make up for the missed deferral opportunity, and then certain contact information. That's what has to be included in the notice requirement of the safe harbor rules. Now, what about the safe harbor correction for 401k plans which have an automatic contribution feature? There's another safe harbor rule with respect to them. Under this safe harbor, the employer does not have to make any corrective contribution for the elective deferral failure. This is if you have an automatic contribution failure, if the following conditions are satisfied. You correct the elective deferral failure by the first payroll date on or after 9.5 months after the plan year in which the failure first occurred, or the last day of the month following the date in which the employee notified you of the failure. So you don't have to make any correction, like the brief exclusion rule, if you correct it within that time period. Otherwise, you're under the normal safe harbor rule, or if you're even later, you're under the general rule. Again, the employer has to provide a notice to the affected participants, and you do have to correct the match. You would have to make a corrective contribution for the plan's matching formula based on the missed deferrals. Let's go through an example. Company X maintains a qualified automatic contribution arrangement, what we refer to as a QACA, on deferrals between 1% and 6%, and becomes eligible for the plan on January 1st, 2017, and makes neither an affirmative election nor a contrary election. She just does nothing. Ann's comp is $5,000 a month. X fails to implement the 3% automatic deferral on January 1st like she should have. They failed to do it until January 1st, 2018, a year later. X will not need to make a corrective contribution for the 2017 missed deferral, because as long as they correct it within 9.5 months after the close of the plan year. However, they will need to make a corrective allocation of $1,200 for the matching contribution. The plan's matching formula is 100% up to 1 and 50% between 1 and 6%. So they calculate what that is based on her full year's compensation of $60,000. and they would make a $1,200 contribution. They will also have to provide a notice to her. Now, calculation of earnings for 401k plans with automatic contribution arrangement, they provide a methodology for automatic contribution arrangements. You may use the default investment alternative as the basis for calculating earnings. Now, if there's a loss with respect to the default investment alternative, you do not reduce the correction by the loss. This is the requirements for the notice for a 401k plan with an automatic contribution arrangement. Remember, you have to give this notice within 45 days. There is a sunset on this safe harbor correction method for automatic contribution arrangements. This will expire for failures after December 31st, 2020. The IRS is going to review this and decide whether to hold on to it or modify it, but there's a sunset. It's just on the safe harbor correction method, though, for automatic contribution arrangements. So let's just chart to help you remember the different rules with respect to it. As you can see under the non-safe harbor, correction time period is first 3 months after the plan year. Corrective contribution is 0. There's no notice requirement. Safe harbor, it's a rolling 3-month period. So any 3-month period after the error occurred, you can take advantage of this rule. No corrective contribution. The general rule is 50% corrective contribution on the missed deferral. Safe harbor, it's between 3 months and 2 years. It's 25%, but there's a notice. And then the safe harbor correction period is earlier of 9.5 months after the plan year of the failure or the last day of the month following employee notification. And again, there's a notice with respect to that. Corrective contributions. For traditional, if you have a missed deferral for improper exclusion, it's the average ADP of the group to which they belong. For a safe harbor 401k, it's the greater of 3% or the highest rate at which the plan matches at 100%. For a missed deferral for failure to implement, it's the participant's deferral election is the missed deferral. Match, for traditional 401k, it's subject to the plan's vesting schedule. For a safe harbor, it's going to be a QMAC unless it's an other match, and then in that case, it'd be subject to the plan's vesting schedule. Now, what about, we're starting to run low on time. I'll move it so we can get done on a timely basis. Now, the EPCRS procedure doesn't really address a failure to implement a change in deferral election. So let's say you had a 3% deferral election and you increase that to 4. It's not discussed, but the principles as well as the safe harbor should be able to be used with respect to that. And you would just, it's a failure to implement, but you'd look at the failure to implement the change and then just apply the rules with respect to that. Example, company X maintains a safe harbor 401k plan that provides a safe harbor match of 100% of elected deferrals not exceeding 4% of comp. Effective July 1st, Mary increases her deferral election from 3 to 4%. Her comp is $5,000 a month, but they failed to implement the change until 6 months later. The missed deferral is 1% of her 6 months compensation, or $300. Since the failure was discovered and corrected within the safe harbor period between 3 months and 2 years, it's 25%. So I would contribute $75 plus earning. I would calculate the match based on the missed deferral and correct that. Now, if the employer had caught the error within 3 months, it could have taken advantage of the safe harbor brief exclusion rule, but they would have still, of course, had to correct the match. Now, what about a failure to implement a decrease in the participant's deferral election? Again, not addressed in EPCRS. So you have to kind of fashion your own correction with respect to this. probably the appropriate correction is to return those deferrals with help from the participant's contribution. If there's enough time left in the plan year, the employer could adjust future deferrals to arrive at the ultimate goal of the participant. Of course, you would have to make certain they receive the proper match with respect to it. Now, if you return elective deferrals to the participant, you're going to have to report on a 1099-R and use a code 7 so it's not subject to the 10% penalty. If there's an employer contribution allocated in there, the employer either should allocate it to the other participants or forfeit and use it for the next plan year. Let's talk about earnings calculations for corrective contribution. As I mentioned, the IRS is a...
Stephen?
Yes.
Stephen, this is Tim. We're at the 50-minute mark. You think you would be wrapping up in the next couple slides?
Yep. I'll just need a couple minutes here.
Okay, very good.
And we should let the participants know as well that the questions that have been asked, we will get them answered and have them on the website.
Okay. Earnings adjustment. General rule, you have to include earnings with your corrective contributions. Reasonable estimates are permitted. Generally, you do not adjust for losses. And you figure out the period of failure. For deferrals, in the case of exclusion of employee, you can use the midpoint. In other words, let's say you excluded them for 6 months. For purposes of calculating the earnings, you can use the midpoint as the benchmark from which you calculate the earnings. Or you can do it from the beginning of the year and adjust the earnings or cut those in half. Those are some of the methods permitted. There are several methods permitted. Now, with respect to matching contributions, it'll depend on the deadline for the matching contributions. The deferrals you calculated from, a few days after the payroll date is when you're going to calculate the earnings from. But for matching contributions, you would do it by the deadline. So in a safe harbor 401k, the deadline for making a safe harbor contribution is the end of the following plan year. And so unless you had a periodic match, which is required to be contributed by the following plan year quarter, you just figure out what the deadline is, and that's the benchmark or the time period from which you're going to calculate earnings. Okay. If you have multiple investment funds, and if most of the employees involved in the error are non-highlights, you can use the fund with the highest rate of return. That's an option. There are various options. If the employee has not made an investment choice, you can use the average of the various investment options that are used, weighted by how the employees use those. There are alternative methods for calculating earnings for elective deferral failures, including if the affected employee has not firmly made an investment choice, then one option under the safe harbor rules is to use the default investment alternative. Again, you do not adjust for losses. Alternatively, you can use the method set out in Appendix B of EPCRS. And this is just a review of how you correct the various elective deferral failures. First, if in the first 3 months, if you catch it within the first 3 months, 0% QNEC. Between 3 months and 2 years, 25%. After 2 years, you go back to the general rule of 50%. And again, if your plan includes a matching feature, you always calculate the match against the missed deferral. Okay, that wraps it up. I'm sorry we went a few minutes over time. Thank you for everyone for participating in there. And again, I apologize for going a little bit over time. Hopefully this has helped you understand how to correct elective deferrals. Tim?
Okay, I think I will pass the ball over to Chuck.
Yeah, good presentation. Thank you, Stephen. And just by the looks of the question board, this is this area is obviously very confusing because we've gotten the most questions on this webinar that we've had on any webinar, but so far
Well,
anyway.
I'll be happy to answer them, and hopefully I can further clarify.
So here's contact information for Stephen as well as for Tim. I know, Tim, we didn't hear a lot from you, but Tim has some observations from his years of experience in publishing and so forth. Remember that you will get continuing education credit for this an hour. We send out the NIPA and the ASPA certificates via email pretty quickly, within a few days. IRPA does take longer because it's a much more manual process. Please check your spam folders. We get a lot of inquiries from people saying, I didn't get it. We have evidence in our server that it went out and it probably got stuck in your company spam folder. But if you don't find it, you can always write us at support@ErissaPedia.com, and we will try to get it to you, an alternative way, via directly or something. Okay, so now what I wanted to do for a couple minutes was again show you on our website where you can go to webcasts and find how to register for upcoming webcasts, as well as get the PDF or the YouTube video of the previous webcasts. We cannot give CE credit for watching the videos, but we have to show evidence to ASPA and IRPA and NIPA that you were actually live in the presentation for at least 50 minutes. So what you'll find on our research platform, we have now added a new product that's going to be out soon. Right now, this is the sample chapter table of contents that Stephen's writing for us on. In this case, it's participant loan failures, but on plan corrections in general. So that title will be added soon. Just to give you an idea, it's going to operate very much like everything else on our platform, with a table of contents where you can link directly to a specific question or issue. You can also just go through and browse and find the section that you think might most likely have the area of discussion you're looking for. Everything's cross-referenced to other sections of the title, to code and regulations, and maybe even to calculators or what have you. The search template will work just fine. Anything you check over here on the left gets searched. You can look for something like unauthorized, if I could spell it right, loans, and it will search inside the chapter to find any time that term is used, probably go directly to a particular area where that topic of discussion is. So our platform is very easy to use, and as you can see, we're just adding content to it all the time. We have the qualified plan e-source, the main product. Darren Watson's, who's the employer, Eileen Ferenczi, by the way, is writing, contributing content to that qualified plan e-source. Stephen's working on plan corrections. We have some experts that are Social Security guys writing our Social Security e-source. Form 5500 currently is written by Tim McCutcheon, who's sort of the 5500 guru, and then Fiduciary Responsibility is a good product written by a former DOL attorney. If you have any questions, you can always reach us via our website. Our contact information is at the bottom of every page. You can write us at support@ErissaPedia or sales@ErissaPedia, or call us directly at 612-605-2266. Thanks, everybody, for attending again. We appreciate your interest in our webinars. We'll try to keep you posted of upcoming webinars and look forward to seeing you at the next one. Thanks and have a great day.